Good afternoon, everybody, or good morning, depending on where you are in the world. I hope you're all doing well, all doing happy and stuff. This is Sam Evans with you for the monthly webinar, Market Timing and Forex for Short-Term Income and Long-Term Wealth. This is part one. Usually when I come on here, I do about 45 minutes. I've got an hour with you now. Then we're going to be taking a half-hour break, and I'll be doing part two for the premium members as well. So I'm going to kind of split this into two ways as well. The first bit, I want to kind of go through some of the concepts and look at some of the opportunities look at some of the things just briefly on the chart. And then on the second half, then we take our break. And in the second chart, I want to really focus on kind of just doing some more of the things, a little bit of slides and more on the chart itself as well. Hi, Donald. I think the administration team are on hand to answer your questions as well. I assume it is recorded and available to the premium members as well on there. Okay. So if you just type in the questions to them as well, that would be great. I'm no stranger to doing these webinars, guys. So I would say make sure the questions are coming. Keep questions. I will get through the questions as we go through. Okay. I'll make sure. Obviously, I keep checking on the chat box as well as going through the material. So I will make sure that obviously we've got everything as it needs to be. And I also just want to make sure that obviously that your questions are being answered as well as we go through. So we will make sure everything's covered. All right. Just to let you know, before as we're getting into this on here, the idea of this is I represent Online Trading Academy. You will see our banner on my slideshow as well. And just before I go any further, is everybody seeing the visuals okay at the moment? Yeah, you should be seeing my slide. You should be hearing me all good. Just a couple of yeses would be good, just to make sure everyone's happy with that, because I'm sharing this stream. Perfect. Thank you, guys. Good. That's all I needed. And I'm one of the lead instructors worldwide for Online Trading Academy. I'll give you all the details. We'll pop over to the website a little bit later on as well. So I represent myself, but also Online Trading Academy. If you want to follow me on Twitter, where I do regular updates and postings and so on, at Sam Evans Trader is the best way to contact me. I can give you my email address at the end of the session as well, but I would rather you've probably focused me on there because I'm checking the tweets and it's easy to have a quick, easy, succinct response. So here we are. We're talking about Forex. We're talking about timing the market and so on, and some of the things that we want to go through. And again, I'm going to go through the concepts on this first part of the presentation. Some of you, if you've ever seen my webinars before, this be a good review for you. Some of you guys who are new into the room and have not done a session with me before, this might be a slightly different kind of take on things for you as well. Importantly on here, the key thing I really want to make sure that we do, and I just want to go into a full screen mode on here, so you're getting the whole thing. There you go. That's probably a little bit better, actually. What I want to make sure that we're doing on here is really kind of getting you into the concepts, okay, and understanding these concepts. I always break it down pretty simply into, I've taught about 5,000 people around the world, and at the end of the day, people are looking for short-term income to supplement or generate a regular income from the markets, or they're looking to do long-term wealth side of things as well. And it could be one of the two, or it could be a bit of both. Before we even look at that, guys, I think the things I really want to focus on in this first half of the session is the reality of the situation around us, the reality of how the markets work as well. Most people, as you may well know, with all the great resources that FX Street provide on here, most people do struggle to achieve their financial goals. And the reason why that typically is of the way that they're thinking. They're not thinking, they're not acting like an institution, yeah, and they're not even aware of it. I'm going to kind of go through one of the things on here, or some of the concepts here, to break down into two separate sets of groups, and then we're going to try to look at what these groups look like on the charts as well. You see, one of the things that's pretty undeniable in this business is there are institutions and banks out there, and those institutions and banks are making or building their businesses on being successful in the markets, whereas retail traders, myself included, as a retail trader now, and retail investors can typically struggle for their profits or maybe losing. I like to hear it when they're just struggling. I don't want to hear it when people are losing. But there's a very different mindset, a very different thing going on between the two people. And what we're going to explore in this and look on a price chart at is how these two different groups are distinguished from one another and how we can focus more on being like an institution and a bank. Before I go any further, I just had a thing here saying they couldn't hear anything. Is everybody else hearing me okay before I go any further? I just want to make sure it's okay before I go any further. Yes? Okay, good. If it was an isolated event, I just wanted to make sure it wasn't an isolated event, or it is an isolated event. Okay, good. So what I'm effectively trying to do here, guys, is say we're all wearing a set of spectacles, if you imagine. We're looking at the market through a certain set of eyes. And there's a lot of information out there, but we've got to make sure that the information is not making us look at the market the wrong way. We've got to look at the market the right way. And my attitude is if you're going to kind of emulate anyone, if you're going to emulate success, if you're going to model success, you might as well model the success of the most successful people. Wouldn't you agree with me? And we're talking about the big banks, the funds, and we'll go through specifically who those institutions are on here as well. So the way I'm going to do this is I'm going to go through these concepts with you. I'm going to show you a number of examples, and I'm going to go over to some live charts as well. So we're going to mix this up. Really, my aim in this hour that we've got is to start getting you thinking like an institution. And in the second session, we're going to see how the institutions look for their opportunities as well. I've been on both sides of it, guys, and I've seen it on both sides as well. Now, I'm going to show you plenty of examples throughout these slides on here. I just want you to understand the things I'm showing you are coming from Online Trading Academy's ProPick service, our market screener tools, our supply and demand levels that are all available to our students within our network as well. Some of the examples of staff trading results, some of student testimonial trade results, all the things I do show you on here as well are all coming from our curriculum, things that have been done in our classrooms, in our online webinars, and the results of our student as well, just so you know from a compliance point of view as well. So what is timing the market? What does it really mean? I found one of the things that revolutionized my trading was identifying market moves before they actually happened with a pretty high degree of accuracy. Now, when I say that to the students I work with in OTA, they're kind of used to it now. But when I come here on FX Street, some people are like, wow, you know, that's a big statement. Well, here's the thing. It is a big statement. If we want to time the market successfully, we've got to learn to find turns before they happen and be able to set up our trades before they happen. Number one, because we want to buy as low as possible and sell as high as possible. And we want to join trends. What do you think? When do we want to join trends? Later in the trend or earlier in the trend? What do you think we want to do? Do we want to join earlier in the trend or later in a trend? What do you think, guys? You got it, Ray. Early. Yeah, we want to get in early because it maximizes our profit and it minimizes our risk, okay? Now, if we're going to do that, we need to try and get in early. And we want to get in early with a very low risk and a very high reward, because the whole reason I'm trying to get you thinking about getting in at these market turns, which I'm going to show you what that looks like, is because the biggest funds, the biggest institutions and the banks, they're the ones kicking off these trends. And what I say is we're kind of like tracking the footprints of the big institutions. And also, guys, whether we like to realize it or not, we're all trading against each other, aren't we? We're all trading against each other. So it's going to be easier for us to start to do this the right way, to start to actually get in and be the ones who know what we're doing, getting in early in the trades when everybody else is joining in. My boss, or my original mentor, a guy who's been very popular on here on FX Street over the years, Sam Side, and he's our VP of Education in Online Trading Academy. He mentored me for many years. He's a very dear friend of mine as well. He once told me trading is nothing more than a transfer of money from the accounts of those who don't know what they're doing into the accounts of those who do. And unfortunately, not so much in the currency world, but in the equities world, a lot of the big brokers on Wall Street are benefiting from getting their clients to buy the wrong stocks. With Forex, is a little bit more of a level playing field, which is a great market, which is why I love it so much. But what we've got to try and do, guys, is think a little bit differently than other people, right? Because, you know, I don't know about you guys, I've been doing this for 11 years now. When I first started trading, people used to go to me, well, where do you make money? Where does it come from? And I used to say, well, the market. The market. It comes from the market. What the heck is the market? I mean, what a dumb statement I made. But I didn't even really think about it, right? I was just like, well, it just comes from the market. Well, there's got to be a bit more behind that, hasn't there? And absolutely, there is more behind it. You're trading against other people, okay? And the key thing about this is to not make the mistakes that other people make. You know, one of the first things I always like to teach people is before you learn how to trade, learn how to not trade. Does that make sense? Before you can learn to trade, you've got to learn how to not trade. What I mean by that is to not make the same mistakes that a lot of people make on here, not come at it with a conventional level of thinking. When you make sure that you don't do the things that everybody else does, the people who are struggling in the market, you're then going to be in a position to start doing the things that the successful ones do as well. Okay, and I know it's a bit harsh, but it's the way it goes at the end of the day. You know, this is the rate of the business. So what I would suggest to you is here, and this is what we're going to focus on, okay, is I want you to take this into account right now. This trading foundation is solid. I think that whenever I get into, when I'm talking about institutions, when I'm talking about the banks and so on, one of the things that always strikes me about them is that they are businesses, right? They're businesses. And as businesses, they have an operating procedure, they have a plan. Obviously, they started small, they've got big. But I always say you need to treat your trading as a business as well. Why is it important to treat it as a business? Guys, it's not a hobby. And anybody in the room with me right now has been doing this for a little while knows that, yes, you can make great amounts of money out of this, but you can lose tons as well. And for every success I've ever seen in the market, I've seen a dozen horror stories as well. And I don't say that to unnerve people, because I think people should understand what the waters are like before they jump in. Well, the way to avoid that is to think about it like a big institution. Think about it and go to the market with a solid foundation. Go to the market with a true plan. And it all begins with the risk management, which I'm sure you've heard many, many times. But I like to kind of just paint things in a slightly different way to see if these things get through to people. So firstly, it's the art of knowing how much you're going to risk when you take a trade. Secondly, it's knowing the correct, proper order execution with a solid platform that's going to allow you to buy, sell, and take profits and get out when you're wrong, automated. Then comes the market and technical knowledge. This is the stuff that you can learn. And I want you to focus on this slide for just a second. Risk management, order execution, and market technical knowledge. This is the stuff that you can learn. This is the education. The tough bit is what comes next. The discipline, the psychology, the confidence, and the experience. Guys, where does the discipline come from? You tell me. Where does discipline come from? Can I teach you discipline? Do you think I've taught 5,000 odd students discipline? Where do you think discipline comes from, guys? I want to get some interaction with you guys. We're going to be together inside of you guys, right, Ray? Okay. Within you, yeah, exactly. You need to do it, don't you? You need to. I always make my little joke whenever I'm in the front of a room. It's different when I'm doing a webinar. Maybe it won't go down the same way because you can't see people's faces. But if you could package up bottles of discipline, what a great business, huh? Selling bottled discipline. It's something that we all have when we want it, but we seem to be able to turn it off when we don't want it. Because every single one of you in the room right now is disciplined. You know that. You're disciplined in some areas of your life. So why can't you replicate that level of discipline into different areas, right? Would you not agree with me on that? If you can be disciplined in one area of your life, surely you could be disciplined in another area of your life too, right? This is something that we need to strongly think about, okay? So that comes from you. Now, the stronger discipline gives you a rock-solid psychology, gives you a confidence, and it gives you that all-important experience, yeah? There's no reason why this bit can't work, but you're never going to get the experience to stay in the game long enough and have the confidence and the solid psychology if you don't have the discipline in the first place to do the things that you need to do. And yeah, patience is a huge part of this as well. My little challenge for all of you guys today is assess your trade plan. How have you accounted for all these different areas in your trade plan? Why is it easier for an institutional trader to be disciplined? I'll tell you why, because they got someone looking over their shoulder saying, you don't do your job right, you're out. You know, some of those guys who have shown lack of discipline in the past, the Nick Leesons of this world, what happened to them? Right? What happened to them? Yeah? Patience, exactly. You guys are saying patience is a huge, huge part of this. Absolutely. All right. So they're the components that we need. They're part of our business plan. There's one other little section of this that I really enjoy as well. The elements that any strategy is required for you to be successful. And by the way, let me state this very, very clearly to you guys. By no way do I think the way that I trade is the best way to trade. I'll make that real clear to you. I don't think the way I trade is necessarily the best way to trade, because there are other traders who make money in the market. Yeah, it's what works for me. Exactly, Alan. Great stuff. I don't put down to what's best, what isn't best. It's about having a structure that works for you as an individual and that allows you to be profitable and manage your risk, right? What I want to do is offer you a different perspective of the market. Not necessarily I'm saying this is the only way. I'm saying to you, here's another way to look at it, right? Because the success is in the results, right? The success is in the results. And the success isn't down to the person. It's down to what that person does. You understand? Yeah? And if and at the end of the day, as long as you're following thing here, it's about stacking probability on your side, because the first thing of all of this is about putting probability on your side, no matter what your strategy is, okay? And ascertaining the risk before you take a trade, and then using the leverage of the markets to help you. Now, one of the things that's really important that I found, and again, I've got people in the room here of varying experience, okay? One of the huge kisses of death I've seen in the market year after year is people jumping into the world of Forex because they're attracted to the leverage. Now, is leverage a good thing? Absolutely. Leverage is fantastic. You look at, but it can also be a dangerous, terrible thing. Just like driving a car. A car's a useful tool, but if you drive it recklessly, it'll kill you, right? Everything's got its yin and its yang, okay? The problem you have with a lot of people is they start with leverage and they over leverage themselves first, which means that they take on way too much risk, which means they eat into their account and they reduce the probability of success. Yeah? So what we need to do is do it in this order. Stack the odds in our favor first, define our risk, and then use leverage. Do you not think that's a smarter way to do it, guys? Get the probability on our side first, define our risk, and then use the leverage afterwards. Our core strategy that we work with is all about the probability and the risk. That's the side of it to do first. And then, guys, we can use things, futures on currencies, Forex, options, equities, and so on, to then have our leverage. So our solution for me is basically having a combination of a solid core strategy that you're going to use and then embracing the leverage afterwards. And this is an institutional way of thinking, right? Understand my market, define my risk, then embrace the leverage. All right, cool. So let's get into the strategies or the principles here that we want to adopt to help us get our levels of success in the market. All right. This was taught to me very early on in my trading career by people who found their way, who were taught and saw the market from one perspective only, and that perspective was from an institutional perspective. The people who I learned from grew up or had their career, should I say, on the floor of the Chicago Mercantile Exchange, the Chicago Board of Trade. And it doesn't matter if it's currencies or stocks or commodities you're trading, these same principles apply. The principle here with the patented core strategy, and the strategy that Online Trading Academy teaches is a patented one. So you'll find we're the only school in the world who teaches it. But our principle is this: the lowest risk, the highest reward, and highest probability entry point into any market, irrespective of what it is going to be at or near the turn in price. What that means is we need to be able to time the market's turning points. And in doing it in advance with a high degree of accuracy, because that defines our risk and also defines our reward. And then in every market, prices are going to turn at levels where supply and demand is out of balance. Yeah? You're going to hear these two words of me a lot today: supply and demand. Supply and demand. When those two things are out of balance, you're going to create moves in the market. Those moves in the market are going to give us a clue where we should be buying and we should be selling. See, all the information that we have thrown at us on the chart is kind of like secondhand information. So we have to use it in the best possible way we can, which comes back to exactly what I was talking to you guys about right at the very, very start. Okay? The institutions. Money's made and lost in the market between the buying and selling among these two groups. That's a great question. Is demand the same as resistance or support? To me, no, Donald, it's not. Yeah, and I'm going to show an example of that during our presentation today as well. It's a really good question. I'm going to talk about the differences between the two, okay? But as I've said to you, what I'm trying to do here, and when I work with the students, is saying, hey, guys, Let's stop you thinking like a retail trader or a retail investor, and let's get you thinking like a bank. By the way, these two groups, these are like elephants and flies. The elephants are the institutions, and these guys are the flies. Yeah? Listen, a fly can't take on an elephant. Heck, maybe just call them elephants and humans. Humans can't beat an elephant. Yeah, we're all flies. I'm a fly in the grand scheme of things. All I want to do is I want to land on the back of an elephant, right? I want to land on the back of an elephant, and I want the elephant to take me with it. Now, the elephant's got a thick skin. It may not, yeah, right? It may not know I'm there. Sometimes it might. And if it's one of those big African elephants, right, with the huge ears, can flap you off, swat you off sometimes, right? That's called a stop out. Yeah, it's called a stop out. Or if it's an Indian elephant, it's got the small ears, but it's got the long tail to do the same thing, right? So there's always a way for them to swat you off. But, you know, if you're smart enough, sometimes the fly will just ride on the back of the thick elephant, you know? I kind of look at it like breaking plates. You heard of the chef Gordon Ramsay? Very, very successful chef. Yeah, many big successful restaurants over the years. Okay. You know, he's got one of the most successful, you know, business models in the world for his restaurants. He breaks a lot of plates as well. Food gets thrown away, right? Every business has expenses. So it's like me getting swatted off the back of the elephant is a stop out. It's a little expense, right? But all I need to do is get on enough on the elephant now and then, yeah? Now, the thing that always people ask me is, well, Sam, that's great. I want to ride on the back of the elephants. Where the heck are the elephants? They're like, where do I find the elephants? Where do I find them? I'm like, well, listen, cool thing about elephants is they're big and you can see them coming. They leave huge footprints and you can also smell them coming sometimes. So that's the thing. We're tracking the footprints of the elephants. That's what we're going to do. We're going to track the footprints of the elephants. Yeah? And we're going to look at that on the chart as well. This is all making sense, guys, yeah? This is kind of the thinking. This is the theory that we're going through. I try to teach in analogies. It's the way I like to do it because, you know, when I kind of come at this stuff, sometimes people are like, oh, supply, demand, I don't really get what you're talking about. That's perfectly normal. Because we haven't really been in, you know, when I was first introduced to the market, no one was talking to me about supply and demand. They were talking to me about trend, support, resistance, moving averages, you know, breakouts, momentum, buy support, sell resistance. No one ever talked to me about supply and demand. In fact, I didn't get it when Sam Seiden started teaching me about it. I was like, it's kind of like wholesale and retail because I was a wholesale retail guy. I'd done a lot of different things, you know, I'd worked from a young age doing different things, buying and selling stuff. Yeah. So I looked at it as a point of view of wholesale retail. Well, demand is where wholesale people buy. Retail is where those professionals sell. We sell, you know, the shops sell to us at retail. Yeah, that's where the supply is in the retail world. The wholesale world is where the demand is created to buy the goods cheap before they go on the shelves. Does that make sense? Yeah, it's just different wording for the same thing. You got it. Demand wholesale. That's what we talk about. Supply retail, yeah? Elephants, institutions, the flies are the rest of us, okay? So who are those institutions, guys? Well, they're made up of banks. They're made up of insurance companies, major investment organizations as well. These are the kind of people. Hedge funds, you got it. All of those kind of people. That's who we're talking about in all of this, yeah? Doing what they do. Now, do they get it wrong, by the way? Let me ask you a question before we. Do you think these guys get it wrong sometimes? Or do you think they just win all the time? You're like, you know, you can get the statistics. If you look hard enough, you can go onto like Goldman Sachs' website and you can download information through there because they have to release certain information because they're trading public money. And over the last few years, Goldman's have been hitting around a 40 overall on their like position trades and overall what they're doing. If you're looking at per trades, they have about a 40% success rate overall. So they'll have up days. They have mostly up days, but even on the up days, they might have a few losses as well. Yeah. So 40% of the time they'll win, 60% of the time they'll lose, but their wins are large. Yeah. And their losses are small. Yet supply and resistance, as you're going to see, are different things to how I would describe supply and demand. Yeah. So I'm going to show you the difference between the two a little bit. We're going to explore that a little bit, okay? Because what I want you to do is I want you to go away from here going, you know what? The way he said that was a bit different. I like that. And by the way, I don't come on here to be different and try to say different things to get an audience. I don't really care if you go away and do this or not. Let me say that. If you go away and try this out or not, doesn't really make any difference to me, does it? Right? I'm here to offer an alternative way of thinking. It don't change my life. Yeah, because I don't believe that, what I'll do is I'll front run. I'll get everybody to trade the way I trade, and then I'll front run. I don't need to do that. You know, my attitude here is I like to kind of share some different ways of looking at the market. I think knowledge is power, and it's a pretty cool thing. So in the 11 years I've been doing this, I've tried a lot of different things, as I'm sure we all have, and I've found this to be a great logical way to approach the market. So let's look at where we find the elephants, guys, yeah? There you go, Jonathan. That's pretty cool. Time to try it on the real thing, huh? Time to try it on the real thing, my friend, yeah? Good for you. Good for you. So, charts. This is where we find the footprints of the elephants. Now, let me just suggest something here to you before we go on. I may, as I go through the course of the rest of this presentation, say some things to you that might sound different to what you've heard before. Yeah? And that's normal. That's fine. I mean, that's good because it means, hey, you know what? I'm not coming on here and I'm saying the same thing as you've always heard every other time. Because I choose to understand this, guys. Let me say this, and this is very, very important to you as you look at a chart. I learned very early on in my career, I was given an amazing piece of advice that didn't sink in for about 5 years. But it was in the first year of my trading education. I had a mentor called Fernando. And Fernando turned around to me and he said to me, Sam, I'm going to give you one piece of advice to take away and remember for the rest of your life. Yeah? And he went, you know nothing. He said to me, you know nothing. That wasn't what I wanted to hear as a young, excited, trading, protege. I know nothing. I wanted to hear that I knew something. But it was like, no, I know nothing. And why I didn't realize until down the line, what he meant is you never know what's going to happen. You can only work with the information that's in front of you, but you have all the tools you need to succeed if you use the tools in the right way and develop a strategy that gives you the success that you're looking for, yeah? And I always say if the way that you're doing it doesn't work for you, then it's time to change the strategy, right? So I just go by what the chart is showing me. I put the impetus on the chart itself. Does that make sense? I let the chart make the decisions. And then when the chart makes the decisions, I decide whether or not to pull the trigger. You're with me, guys? All cool, yeah? Carlos is just saying, does supply and demand work on bigger time frames? I'm an old guy. I trade on 240-minute charts or bigger. I'm a young guy and I trade on 240-minute charts or bigger. It don't matter. I still feel young anyway, Carlos. Works, absolutely. The great thing about this is it's all different time frames, all different markets. We're not going to be able to go as deep as I could do in a class, when I'm teaching a 7-day class, but you'll get the idea of it. Absolutely. We look at big charts, small charts. Okay. And absolutely. I mean, the bigger the charts, the better it can be because you've got less opportunities, right? Less opportunities to jump in. All right, let's carry on. So all the influences that can happen on price are all going to be reflected on the chart. So, we've got all things like last night we had FOMC reports, right? You saw the way that the market moved on Fed Day yesterday. Different economic news, income statements, balance sheets, Fed announcements. Okay, I'm going to actually show you a great question, Will I trade on news? I'm going to come to that when we look at a chart. Would you remind me of that question in about maybe 5-10 minutes or so when we go over to a chart? And I'll show you some levels that triggered that I put down with my class off the back of FOMC. Yeah? And we'll talk about that a little bit more specifically because that's a great question. I can answer it in the short way here. Let me tell you this now. I'm not a news trader. I don't get the results and then try some complex strategy to try and catch momentum. I don't believe in that. I let price come to me. So if my trade gets triggered off the back of a news event, so be it. But typically it gets triggered off the back of a news event, or I'm already in the trade as it happens. Does that make sense, sir? I'm not one of those guys who sits there on Forex Factory as the news is coming in and go, oh, the news is good, better buy it. I've done all that, got my fingers burnt. I've always said it this: if news trading was easy, everybody would do it. You understand? If it was as easy, it always makes me giggle, right, guys, when people go, oh, Forex is such a great market, everybody gets the news at the same time, it's really fair. It's like, if you really believe that all the big institutions get the news the same time as you, you're a very naive person. You don't think that some of those big boys already know what the news is going to be 5-10 minutes, maybe an hour before the rest of us, before it gets on Forex Factor or FX Street. And even so, if it was as easy as to sit there waiting for the news, if it was easy to sit there, wait for the news to come out, and then, oh, the news is good, buy it, I'll make money. Oh, the news is bad, sell it, I'll make money. If it was that easy, then that's what everybody would do, and nobody would ever come on a webinar or read a book or go and get education about trading, because they just do that, wouldn't they? Do you know what I mean? I'm really kind of black and white about that kind of stuff. I look at the results people are getting, and I'm like, if that stuff works, then you don't come and see me, would you? You ever want to do it, right? So yeah, I let the market come to me. News is funny, Jonathan saying, with all the revision and stuff. Why release news if you don't know the right figures, right? I know. I mean, it's crazy. Someone said to me, one of my students, said to me, I did all my trading. I'm a day trader. I day trade futures every day. Forex is what I do from my long-term and medium-term trading, guys. Long-term and medium-term trading is what I use Forex for. But I'm a stock index futures day trader. That's my living that I do. Okay. And it's really funny. I don't read the news. I'm not interested in the news. I don't care about the news. The news just tells me what everybody else is looking at, and everybody else is struggling. So I'd rather just focus on what's in front of me. My point is this. I described FOMC. Someone said to me at one of my students, aren't you going to trade FOMC? This was last night. I turned around and I said, FOMC to me is like me standing in the middle of a playground with 100 children running around with sharp objects after they've consumed too much Coca-Cola and boiled sweets. Dangerous, erratic, and crazy. I don't want to be involved in it. That's my description of FOMC and non-farm payrolls. So I'd rather just stand on the fringes and let the chaos happen. You know what I mean, guys? But we'll, you know what I mean? Yeah? All right, let's get this going. So we've got all this information that can come out. All it's going to do is create thoughts and perceptions. Yeah? And those thoughts and perceptions are going to create the actions to buy and sell, aren't they? Yeah? That's all it's going to be. So all we see on a price chart is everything that's already happened. So when we approach this, we've kind of got to come at the chart saying, well, what's already happened? People always say to me, oh, I'm tired of being on the wrong side of the trade. It's like, it does my head in. I've seen charts that look like this, yeah? I've seen charts that look like this. And while there's all this great information out there, it becomes so difficult to ever make a true decision if you're focusing on all this information here. It's almost like taking a recipe, isn't it, and putting too many ingredients, and you just get a garbled mess at the end of it. All of these things here, don't ever buy in a downtrend. Old resistance becomes new support. Indicators must line up. Wait for confirmation. Look for volumes. Trend is our friend. Listen, at the end of the day, there's all that stuff going on, guys. But the most important thing that we've got to understand on here is there's only one leading indicator. And what is the only leading indicator? Price itself. Yeah? Price itself. Yeah? Listen, if it works for you, right, Donald, then that's great. You may be here in this webinar wanting to excel your results. Not everybody who I teach or I meet is a struggling trader. A lot of them are. Okay. But also, some people come and they're like, well, I want to be better. Even the great sports people have coaches, right? It's hard to tell if someone's being sarcastic on one of these things, so I like to answer every question objectively and make no assumptions. But thank you for the heads up, sir. What it looks like is this. Every candle that we've got is created because of really what's going on between the supply and demand, and people's fears, values, greed, all of that is purely based on their buy, is based on what they think. But I don't know why people are going to buy and sell. All I want to know is where do they buy and sell. Now let's assume we've got a price at 41.30 right now. There's 100 people willing to buy. Am I ever going to know why 100 people are willing to buy here? Would I ever know at any given time why somebody wants to buy? Never. I can guess, but I'm never really going to know, am I? Okay, that be a fair assumption? There may also be people who are willing to sell at that particular price, right? Do I know why these people are going to sell? No, it's just orders. What has to happen, however, before this market can go either up or down is these people need to be given a chance to do business. So these 100 people satisfy 100 people who want to buy. The 100 sellers satisfy 100 buyers, but we've still got 300 buyers, right? Now we've got no willing sellers left. What we've got is demand without supply. What does that create? That's what creates the green candle. It's not the news that creates the green candle. It's not the economic event that creates the green candle. It's not the fundamentals that creates the green candle. It's the fact that the sellers were done selling and there were still willing buyers at that price that created the green candle, because there was an imbalance between buyers and sellers. Because the law of motion is basically, or the origin of motion and change in price is an equation where one of two competing forces, those buyers or their sellers, become zero at a specific price. That's what creates the green candle, right? So if we know that it's literally orders that create the candles, what we've got to do is maybe step back a second and go, okay, what can I find out by understanding that there were 300 unfilled orders here? There were originally 400 and now there's 300 and the sellers are gone. And I got a green candle. Maybe that's going to tell me something about what may happen if the price comes back there again in the future. Yeah? It's the lack of sellers that causes the price to go up. Maybe I'm never going to know for sure if they're going to be there, but I will base my analysis on the fact that it happened before, that it may happen again. And why may it happen again? Because human beings are creatures of habit, because these are institutions. Think about this for a second. If you take an absolute low and you take an absolute high, the reason lows and highs are the reason highs and lows are created is because of huge imbalances between willing buyers and willing sellers. So if you take a look at the middle of a chart right now, like when a price is just ticking along in the doldrums, there's easy to get in. There's like loads of trading activity because everybody can buy and sell at the price it is now. But not everybody gets a chance to buy it when it was at the lows or sell it when it was at the highs. What did they? The whole reason a low is because there weren't enough people selling to satisfy the buyers. Does that make sense? The reason a high is because there weren't enough buyers to satisfy the sellers. That is logically, technically, under the surface, why a high and a low is created. Because of willing buyers and willing sellers. And that doesn't just relate to this market. It relates to every market in the world. Houses, cars, commodities, consumer staples, the food on your table. It's supply and demand. Yeah? So we've got to start to think about it for a second and go, well, now, if I know that the high, clearly a low, any low of a day was a high competition area to buy. Why? Yeah? Why? Why is a low a high competition area? Because it was a low. It tells me that alone. How do I know a high was a high competition area where people were dying to sell? Because it was a high. It wouldn't have been a high if it wasn't. Do you understand? It can only be a low because there were more willing buyers than sellers. It can only be a high because there were more willing sellers than buyers. It has to be that way. Do you understand? So the question we get after this is, so how do you know if the orders are still going to be there? You don't know if the orders are still going to be there. Silence. What you do is you trade what you see. You trade what the chart is telling you. You never know if anything's going to work. You never know ever. And that's the bit, it's the not knowing that makes people struggle to pull the trigger. And that's where this becomes more about psychology than anything else, because you never know. And unfortunately, that's the nature of the business. In life, what do you ever really know? You stack probabilities in your favor. You could be the world's greatest driver, right? but there's no guarantee someone else can't hit you. Does that make sense? You could be the world's greatest driver and be the safest, most aware driver in the world. Does that guarantee that somebody else, bam, isn't going to hit you? Right? That's the thing. It's probabilities. Let me ask you this for a second. The casino's profitable? The casinos make money, good casinos? Absolutely. And they lose money all the time. They've got probability on their side that means that they make more money than they lose. It's that mentality, guys. You understand? So when we look at it this way round, it's just orders. It's just orders. And that's what we're looking at here, right? That house has the odds in its favor. So let's just take a look. This is how we're looking for those footprints, yeah? Let's look at some footprints of institutions, my friends. Let's look at some footprints of institutions. I want you to focus on this section of the chart here, okay? I want you to focus on this. This is the NASDAQ, by the way. It doesn't matter. This is the NASDAQ. It could be anything. It could be pound dollar. It could be euro GBP. Don't make any difference. Listen to this. I want you to imagine that this move here hasn't yet happened yet. I want you to just focus on the yellow box. Rallied up, the price based sideways and then rallied again. Yeah? There's two things I know about this little yellow box. This little yellow box that I've got my laser pointer under at the moment. Firstly, I know that institutions were buying there. How do I know institutions were buying there? I know institutions were buying there because institutions have buying power to create big moves up and big moves down. Individuals don't. Does that make sense, guys? Institutions have the buying power to create the moves. So it's going to be institutions who kick off every move, right? Because we can't do it. Yeah, we sit there, and who here in the room has sat there during the doldrums of the market when it's just ticking in a few tick ranges in a tiny little pip range doing nothing? And they've got bored and they've clicked the button and actually been able to move the market. Anyone here? Because if you have, you shouldn't be in this webinar, right? Or if you have, we need to talk, right? Because you are a market monster. You're a leviathan of the market, yeah? But an institution puts a big order in, it's going to create some serious demand or supply, right? Because it's the lack of people on one side of the trade that allows the move to happen, not the other way around. It's not because there are more buyers. It's because there are a lack of sellers that price goes up. It was the lack of sellers. There were more people in this yellow box willing to buy. First thing I know is institutions made this move. The second thing I know about this area is there were more willing buy orders than there were willing sell orders. How do I know that for a fact? How can I say that? Because that is the truth of what is on the chart. There were more willing buy orders because once the sellers had done selling, there were no more people willing to sell. Supply disappeared. Demand was still present. That is why prices had to rise. Does everybody understand that, guys? Yeah? If there were equal amount of sellers in this area as there were buyers, what would have happened to the price? It would have just trickled along sideways, wouldn't it? You got it. So knowing that for now, if price comes back to the area, we extend this area forward. A good strong move away, Carlos, is nice. I want to see a good powerful move away, my friend. I want to see like a bit of a rocket ship. Yeah? The faster the better for me, my friend. The faster the better. When price comes, that means there's a bigger imbalance. Yeah, that means there's likely a bigger imbalance if there's a big powerful move away from the zone. Yeah? That means when price comes back at this particular point here where my laser pointer is, I've got to make a decision. What's that decision got to be? Am I going to take an opportunity to buy this thing again? Yeah, I am. Why not? What's the worst thing that can happen? If price comes back here again, what's the worst thing that can happen? It goes below here and I get lot and I lose a little bit of money. What's the best thing that can happen? I make a lot. See, there's no guarantee that prices are going to rise here. I don't assume to know that the market's going to go up from that particular point. My job as a trader isn't to get it right all the time. My job as a trader is to buy in areas where I can see a low risk, high reward buying opportunity and sell in areas where I can see a low risk, high reward selling opportunity based on the information that I've got. And the only information I've got is that chart. I have nothing else. And I know for a fact that any business is going to try and buy as much as it can when it's cheap. Why? Why does it make business sense to buy as much as you can when it's cheap? because your risk is low and your reward is what? What's your profit margin like the lower you buy? Higher. I'll prove it to you. It's like this, guys. I want to sell as much as I can high, right? High. People are going to be willing to sell high. If your house was worth $500,000 right now, and somebody knocked on your door and said, I want your house, and you turn around and said, it's not for sale, and they say, I really want your house. I'm sorry, it's not for sale. I'll pay you $1.5 million for your house. You'd probably take it, wouldn't you? Right? You're going to sell as high as you possibly can if that happened. It's the same thing. What I'm doing is stacking the odds in my favor. I'm a casino. That's it. I'm a casino, guys. Nothing more, nothing less. The key thing that I'm doing is avoiding the middle. So look at the structure here. You see the tight base here and then this really strong drop in price that we see. This strong drop in price. Do you see the tight base here and that strong rally in price? You see that? I don't want to sell here in the middle. Why? Because in the middle, that's where it's easy to get in. But what are my profit margins like in the middle? They're not there, are they? They're not there. I'm in equilibrium. So I want to buy at the lows near areas of demand and sell at the highs near areas of supply. Now, the games come in. How many times have you watched a chart fluctuate up and down and keep retesting a level, retesting a level, retesting a level, and you think the level's going to break and then it completely reverses? You seen that, Frank? You seen that? Where you go. If you've seen that, there's one of the games. Keep re-hitting an area. You think, this is the time it's going to break. This is the time it's going to break. How many of you guys have taken a trade and watched it start to move in your favor and you've moved your stop loss to break even? It's come back. It's stopped you at break even and then it's gone off without you. How many times? Give me a yes if that's happened to you in the room. I'd expect a lot of yeses. There you go. Why is that happening? Games being played. Today, there you go, Steve. Thank you for your honesty. Yeah? Question, I know the markets trend at times, you know that volatility in trading markets varies. Also know that non-volatile trends at times give us better opportunity. How would you use S&D to corrective market? Do you believe S&B technique is the best tool trade ranging? I believe that supply and demand applies across every time frame, and with the correct multiple time frame analysis, Carlos, you will always I trade the strategy I trade in all market conditions. Trending, ranging, irrespective. If you know what you're looking for and how, this is the first piece, this is the supply and demand piece. When you start to understand how supply and demand fits in with bigger picture trends as well, it's all applicable, sir. Yeah? Okay. The other thing to understand as well, where catches people out about buying low and selling high, is the market's always typically going to be high on great news. This is where people the big boys are selling to people who want to buy on the great news. When the market's on its knees, this is where everybody else wants to sell and the big boys are willing to buy from those people who want to sell. Yeah? Okay? It's all just tickets at the end of the day, guys. That's all it is. It's just tickets. Okay? And what we're looking for, okay, is just price levels that correspond to these tickets. Let me just go through a couple more points over this last 10 minutes, and we're going to just go into a little bit more of the structure of it, okay, to go for a little bit. Yeah, show you a little bit more of the structure you should be looking for. People ask me, demand, is that support? No. Demand to us is a price turn higher at a level where there's greater demand than supply, more willing buyers than willing sellers. Supply is not resistance in my book. Supply is a price turn lower at a level where supply is greater than demand. More willing sell orders exist than willing buy orders. The other thing that we always forget about, to me, which is the most important bit after you've learned a strategy, is who's on the other side of your trade. A pro or a novice. You see, I want a novice on the other side of my trade. I like trading against people who trade with their emotions. When a market starts to go in my favor and pulls back to my entry point, I don't panic. I smile because I expect that things like that are going to happen. It happened to me yesterday when I was short selling the NASDAQ. I shorted at the highs of the day. It dropped down and then it retraced all the way back to my entry point, went a few pips beyond it and then dropped like a brick. Because if I'm going to enter at key areas where institutions buy and sell, I've got to expect that there's going to be competition there, right? I'm not going to expect it's always going to go my way. It's going to go the way it's meant to go. And those emotions of fear and greed, fear and greed hurt people. We're going to get to that in just a second, Carlos. Okay? So, where do market prices turn? Look, we're looking for the chart to tell us. You're not going to know a supply level until a supply level represents itself. So, we know that this here is a supply zone. Why did prices decline here? Because there were more willing sellers than buyers. The origin of any move in price is where there's an imbalance between supply and demand, right? So we know it's a supply zone after it's created a supply zone, right? And what I'm looking for is a base and a strong drop, a strong, powerful drop away from my area. Yeah, ceiling. I only know it's a demand area when I see a base and a strong rally in price. So I have to wait for supply to present itself, and I have to wait for demand to present itself. So when I know this, then and only then do I know what to do. Does that make sense? So I'm not asking you to know when this drop here is going to happen. I'm not asking you to know when this rally is going to happen. I'm saying you've got an idea of looking to spot these supply areas and these demand areas when they've already been created. Is everybody clear on that? So we've got to wait for the levels to present themselves first, because if the level hasn't presented itself, how do I know where I should be buying and selling, right? Once we've done that, then we can go to the other side of this and say to ourselves, all right, who's on the other side of the trade? See, think about this for a second. Look at this area here. See how price is finding support? See this area where the price has dropped and you see it's finding support across here. Good old support, yeah? Well, you may be thinking to yourself, if you didn't know about supply and demand, well, now's a good time to buy, but I don't want to be the first. It's better to be safe than sorry because, everybody's been telling me over the year, since I was a little kid, better be safe than sorry, better to be safe than sorry, right? So you're like, okay, better to be safe than sorry. So I'm going to wait for a series of higher high, higher low, higher high, and then I'm going to buy when I've got confirmation of a new upward trend, because the official new uptrend is a higher high, higher low, higher high. So now I'm going to buy. But the problem that they've got on here is they've bought, but they don't realize they've bought into an area of supply. What happens is they have a buy, price starts to go against them. That person is now panicking. That person panicking is now seeing this go down in price. Well, they're like, now they want to get out because they're losing money. Well, if they were a buyer, they need to sell to close the trade. But every seller needs a what, guys? A seller needs a what? A seller needs a buyer. So who do you think's buying at this particular point from that seller? Who do you think's buying at this particular point? Somebody who knows what a demand area looks like, who knows how to buy low and is not afraid to wait for confirmation. Who takes the trade, defines their stop and their target, and is one of the earliest people to buy. Yeah? If we scan through a little bit on here, guys, this is what we're looking at. These are the things that we're thinking about. Let me show you this. No, if the price doesn't get it, happened to me today, Will. What a great question. Sometimes price never gets to our zone. Should we chase it? Not at all. Obviously, there are more advanced strategies that I teach that can allow people to do that to help get them in. But I missed my trade on the Nasdaq by 4 ticks today. But I set and forget it. It missed by 4 ticks. I've got a long day ahead of me. I can trade all through the rest of the day. So if another trade comes up, another trade comes up. You got to just look at it for what it is. This is the support resistance trap I was talking about, which is the thing I'm going to leave us on to take us up to the top of the hour. And I'm going to be taking a half-hour break, and hopefully some of you guys are going to be joining me for part 2, and I'm going to go into, drawing these zones, the part 2 of this, of more examples of drawing these zones. But let me show you, and then I'll show you an example that recently, a couple of examples that are just triggered from yesterday from a real chart as well, okay? So see what we've got here. We've got support, right? What's the current trend? Boyke, you don't know. You have to draw a line in the sand and go, that's my spot based on what the chart's telling me. All you know is what the chart's telling you, yeah? You don't know. So you just trust what you see on the chart, right? That's all you do. You have your entry, you stop, what you're willing to lose, and then you go for it, my friend. That's it. You don't. And anyone who tells you you do is fibbing, because no one knows, right? What we do is use probabilities that work for us, okay? So we've broken support. We're in a downward trend. What's the sensible trade to make? What's the sensible trade to make? Well, a lot of people are going to be selling. Novices are selling the breakout. Yeah. Good, but we are better because old support becomes new resistance, right? So maybe we should wait for the price to rally a little bit, yeah, before we sell. So the smart thing is to buy the dips and sell the rallies. So I'm going to sell now price hits this old support area, assuming it becomes resistance. This is the classic conventional method of doing it. So the book says sell at resistance. Place the stop loss just above here. Yeah? Well, do you not think that these people know your stop loss is going to be there? Because if your buy stop is just above the entry, if the price then breaks above that resistance area, you're going to get stopped out on your short trade, right? But if you sold and you've got to buy back now, a buyer needs a what? Seller. Well, who do you think is selling here in this drop supply zone? Who's selling here? Who did that buy stop trigger a sell order for? The banks. The people who knew that everybody else's stop's just above that line. So the person got the direction right, but they got their timing wrong. The problem is waiting for a candlestick pattern confirmation is it's going to be too late, because if you get a close way down here, you're going to end up entering the trade so late that your risk is going to be reduced and your reward is going to be your risk is going to be increased and your reward is going to be reduced. You know what I mean? The novice trader is being trapped into buying at a retail price, and their buy is actually triggered from a buy stop of their original sell. That's why we're going to look for zones, guys. All right. Lovely. Thank you.